I'm Sarah Williamson, and this is Going Long with FCLT Global. On this show, you'll learn what it means to be long-term from the top minds in global business and investing. Leaders from companies and investment organizations join us to discuss how they are leading their teams for the long run on issues including capital allocation, risk management, climate change, and sustainability. To learn more, visit our website at fcltglobal.org.
Erik van Houwelingen is the CEO of Kempen Capital Management, the asset management team of Lanschot Kempen, an independent wealth manager based in the Netherlands. Erik leads the asset management business and recently joined its executive board. Most recently, he was head of the client group at Dimensional Fund Advisors in London, responsible for client and business development with a focus on continental markets. Erik and his team at Kempen have been members of FCLT since the beginning. So thank you very much, Erik, for joining us today. We really appreciate your time.
Yeah, my pleasure, Sarah. It's great to be online, so to speak.
Great. So for those of our listeners who are not as familiar with Kempen, can you talk a little bit about who Kempen is, what the origins are, what your objectives are?
Yeah, sure. Well, the origins actually go a long way back. The firm was founded in 1737, making it, the oldest independent financial institution in the Netherlands and one of the older institutions in Europe. Independent, we're listed on the stock exchange, and have a long history as a result in both private banking, but also in asset management. The private banking is coming from the Van Lanschot part of Van Lanschot Kempen, and the asset management part is coming from the Kempen side of Van Lanschot Kempen. And we're basically much more of a wealth manager today than what we've been in the past. So a long history of banking type of activity, but increasingly, the bank has started to focus on wealth management activities in the combination of Van Lanschot Kempen. And that's really where we are today. So yes, we still have savings and loans and mortgages, but the ballpark is wealth management. And that's the part that, within the board, the management board of Lanschot Kempen, I'm responsible for. So that's really a combination of what we call the fiduciary management type of activities, that we have for all client segments, be it, a private client to, a bigger institutional organization like a pension fund. But also, we manage money ourselves as well. So we have, internal competencies with which we provide also products. More on the, I would say, on the niche side of things. So, not plain equity portfolios, but, long heritage, for example, in small caps. The thing of the combination of the two is that we're really long-term investors. We manage for the balance sheet of these individuals or these pension funds. In both cases, it has a long-term orientation. And that also explains, not only the heritage, but also kind of the way we look at wealth management. And it also certainly explains why we were there at the start of FCLT, because we also very, very much believe in the long-term focus when it comes to investing.
Well, 1737 is that certainly is long-term. That's not a founding year we normally hear. So obviously it's work. So how do you, whether you think about the institutional investors in particular, how do you build those strong relationships with the clients? And in particular, I'm interested in how you've used the investment mandate, because as you know, we've done a lot of work together on that, which is how an asset owner structures a relationship with its asset manager in terms of the mandate, in terms of how the incentives are structured, how that relationship is structured, even the performance reporting, all of those sorts of things really does affect that relationship. So how have you used, how have you built those very long-term relationships? And in particular, how has the mandate structure played into that?
Yeah. Yeah, great question, Sarah. As you already a little bit alluded to, it's an area where we've done also work together, actually published a few pieces for those people that are interested. Let me just kind of take a step back and let me, kind of explain how we look at the business and then answer your question, because the total balance sheet AUM that we manage for clients is around 105 billion, and 2/3 of that is what we would call fiduciary assets, and the rest are assets that we manage with our own teams of portfolio managers. So if we focus on that primarily, but the answer would also be the same for our fiduciary management relations with the clients. It all starts, with the idea of being in a long-term client-supplier relationship. We don't typically sell product or solutions. We start by building a relationship. I mean, obviously that can also come through an RFP, but the outset is always, okay, let's look at this from a long-term perspective. What are the goals? And with the type of clients, that's seldom, well, I need to make this return next year. Yeah. So that really, I think, starts to frame the type of conversation that we have. That is necessary also because if I look at these investment strategies, and let's just take small caps that we've been doing for more than 30 years as one of the key pillars. Our investment horizon in those strategies, whether it's global or European or maybe even a little bit more local, is an horizon of 5 to 10 years. So that's what we're talking to clients about. This is not about next quarter's or even next year's performance of the fund. It's about a track record, and it's about investing in a concentrated portfolio. In our global portfolio, we have, for example, 70 names, so very concentrated. But it's only because we know these companies really, really well, that we are also able to invest in them for the longer term. If that's the case, and if a client buys into that frame of long-term investing, then also the mechanism of engagement becomes a different one. He doesn't get unsettled if there is a negative performance, relative performance in 1 year. And obviously we look at 1 year, 3 year, 5 year performance, that those are the dynamics of the business. So there's no doubt about that as well. But we basically invite a client, also to be there and to look at that for the longer term. So that's the outset. That also means that the mechanism by which you structure that relationship starts to look a little bit different. They're interested in what we do in these portfolios with these companies, also from a sustainability angle, for example. We know these companies well. We speak to their directors on a very regular basis. We have discussions with them. We are sometimes invited, to also comment on their strategy or their sustainability program. So it's a very different set than, being in the market temporarily, in and out of companies. There's nothing wrong with that, maybe, but that's not who we are. And that's not the way that we engage with our clients. And I think from, kind of looking at the numbers and how the fiduciary management business has been built over the last 5 years, going from 25 to 70 billion, how also our own internal strategies, it works. And it works in the Netherlands, but it also works outside the Netherlands, because obviously we have our base in Holland here. But, most of our success right now is in the UK. So it's making the connection, I think, that counts, and not necessarily, that we speak the same language in terms of, a language.
Well, and I think what you said about, which clients you get is so important, because I think one of the things that we've seen time and again is that asset owners, despite their best intentions, tend to buy high, sell low, in terms of they invest in things that have just done well. And then once they hit a little bump, they get scared and run for the door. So I think that almost, that expectation setting, as you mentioned, that they are less likely to get nervous if there's a deviation is such an important part of this process. So do you think that is the clients that is it the clients that you happen to work with and they're longer term, or do you think you've sort of trained them or set the expectations? In other words, perhaps they would be shorter term with another manager than with you, or are they just longer term clients to start with? How would you guess there?
Well, you know, you will never hear me say that we're training them. I mean, that I think kind of speaks for itself. But I think what we do is in that first part of the relationship, whether they're an existing client or a prospect, is to spend, relatively speaking, a lot of time on, I think the words that you're using are appropriate, building expectations. This is who we are. This is what we believe fits with a long-term investor. And these pension funds, and also most of these high net worth individuals, are long-term investors, because, you know, they're thinking obviously about plan participants and people that will have their pensions in 10, 20, 30 years. But, you know, what we see on the private banking side is that people are usually very, very much involved in kind of family estate type of planning. So also planning for the next generation, not so different, right? So setting that and having that true conversation and setting the expectations, that's mission critical, because that's what you can revert back to further down the road. And it's a plant that you need to give water continuously. But that first part is truly important. That also means that, you know, that there are clients that, you know, maybe do not fully buy into our story or make other choices. And that's fine. But for the most part, I mean, if you have a long-term horizon, you should be interested, I think, in the story of a long-term investor like we are. And I know, you know, some of the other partners in FCLT are as well. It makes sense, right? So I think, you know, we have a little bit of a natural benefit there, because it would make no sense to me if a long-term investor were not interested in a long-term investing story.
Yeah, that makes sense. So one of the things you mentioned is that you manage quite a bit of small cap money. And obviously those companies tend to be either growing or, you know, or more focused. How do you think about engaging with them? And presumably you know them well, you're a large investor for them. How do you think about your ability to engage with a small cap company relative to, you know, a global multinational? And are they receptive to that? Do they, how does that, describe that interaction for us a little bit?
Yeah. Well, the quick answer is yes, they're very receptive. But let me build that up a little bit. You know, I think engagement is obviously a very important component of, you know, a sustainability agenda for asset owners, and with that also for asset managers, right? And you see that all around us. You know, it's a big thing to talk about engagement. You know, I think increasingly people are also asking the question, well, what does that mean? You know, what is the impact? How do you measure that? And, you know, we're all doing engagement by voting, sending letters. I'm all for that. But, you know, what is the impact? And then it becomes often a little bit more difficult to answer that question and to give substance to, you know, what the outcome is of your engagement. You know, I wonder about that sometimes. And also for our organization, you know, the challenge that I provide the organization is to continue down that road of, you know, making sure that where possible, you know, our engagement also has an impact, and to document that. The small cap strategies are I think the best showcase of that, but we're trying to do that with our other strategies and competencies as well. Because it's exactly like I said just a little bit earlier, you know, in such a concentrated portfolio with a longer term horizon of 5 to 10 years, knowing these companies well, being invited to comment on their strategy, that's actually a sweet spot for engagement, because they listen to you, right? And you know, we actually also published that on our website for people that are interested, but to kind of look at some of these cases. And, one of the cases that you will find there, for example, and this is one that I find particularly interesting, is a German company that recycles waste out of the steel manufacturing industry. It's called steel dust, and it's really nasty stuff. So you're thinking, this is at the extreme of everything we're talking about making the world greener, and all of the objectives that we have. At the same time, it very much fits in kind of a circular world, where you're trying to extract out of waste materials, to separate them and to reuse them. And this was an organization that had no ESG footprint in terms of a ranking. It was a little bit down in the rankings of ESG rating providers. And because we've known them for such a long time, we started to engage with them, and we were actually asked to do kind of an ESG mapping. What would we need to do in order to basically build our profile, because we're basically circular, but we have a bad image, right? Because we're in the steel recycling, steel dust business. It's a great story, I think. And they did a stakeholder analysis and everything else. Now they're considered one of the leaders in the space. Granted, that's what they did, but I do think that we helped them a little bit in that process. And those are the good, beautiful stories. And if we have enough of them, then engagement and having impact in engagement, really starts to work. Sometimes very difficult, if you engage with one of the larger companies, and but they're also better equipped, of course, to deal with it. They have their own IR departments, their own sustainability departments, and it's difficult for them as well to handle all of the questions that they get from asset owners and asset managers. But with these smaller companies, they don't have that infrastructure, so they actually also appreciate the direction and the help from outside, and that combination, I think, makes it possible to have hopefully a true impact.
That's a great example. And I know the Netherlands broadly and Kempen specifically have been real leaders in terms of thinking about sustainable investing for many, many years, long before many other parts of the world got on board. Can you tell us a little bit about your sustainability center? What does that do, and what is the role of Kempen's sustainability center in this whole process?
Yeah, maybe just to set the reference a little bit for the audience here. Like you said, on the Kempen part of the Lanschot Kempen equation, i.e. the asset management part of that, long heritage. By the way, I don't even dare to say that we're leaders in the space, because I think everybody thinks they're a leader in the space. So better to back that up, I think, with some evidence than just to claim, but that's a side note. I think we feel very comfortable on the asset management part, but in the broader business, the wealth management business and the private banking, there the whole theme of sustainability / ESG is relatively, well, it's not new, but it's certainly not the same track record as some of these pension funds that we have in the Netherlands, and some of these funds that we've been providing services to, also on ESG and sustainability. So it was felt that kind of that momentum and that level of knowledge on the institutional side, we should basically apply to the broader business. And that led us to basically setting up a sustainability center directly under the CEO of the organization, and then obviously fed by what we have in terms of experiences in the asset management side, but to look at that for the broader organization, the broader institution, so to speak. I think it's been working well, and it's been working well, I think, in two areas. In what we now provide in terms of solutions to our private banking clients, we see a true acceleration. We had a sustainable offering next to some other offerings. Now we're on a trajectory to in 2023. So, 2 years from now or a little bit less, all of the offerings will be sustainable. And not only the offerings on the wealth management side, but also when we look at, our savings products, mortgages, our loans. Now, there's a whole story to tell there, but, that is basically taking the organization to a level of sustainability where we can proclaim, that we are a sustainable organization. That is irrelevant of, our pledges and everything else. It's just in our offering and what we provide to clients. That's also increasingly saying that some clients that, have nothing to do or don't want anything to do with sustainability, that maybe, we are not the right partner for them. And that's sometimes a very difficult the discussion. Obviously, we'd like to do that in transition over the next couple of years. And it's interesting, I mean, just to give you a number, the flows in the sustainable propositions that we have on the private client side. I think for new money coming in, right now, it's about 2/3. It's a big number that is going to sustainable solutions versus some of the other solutions that are not necessarily great, by the way, but are just different propositions and do not advertise themselves on a sustainable label. So that's fascinating to see, in an area where you're thinking, well, are people ready for that? And it also, gives further, I think, support for that journey that we're on. And the last thing I think to say around the sustainability question that you just asked is, it's also throughout the organization about behavior and getting ready. We're already in the midst of it, you can argue, but, getting ready for what you could argue, are the most turbulent years when it comes to the actual transition. And they are ahead of us. We're speaking the next 5 to 10 years. That's when it needs to happen. It sometimes feels that we're still taking baby steps because so much still has to take place. From a strategic level, we feel just like other organizations, but certainly also for Lanschot Kempen, it's not a bet. It's a certainty that it's coming. So you better be prepared. So that's another reason to anchor that at the firm level and not only at the asset management part.
That makes a lot of sense. It's interesting.
I hope that makes sense. Yeah.
It's interesting to hear you say that if there are clients who are not interested in sustainability, that perhaps you're not the right partner for them. I think there are a lot of managers in the world who are offering sustainable products, but they also still offer a lot of the other side, if you will. So how has that conversation gone with somebody where you say, maybe it takes some time, but either we're focused on sustainability, either be part of that, or maybe we're not the best partner for you. How do you do that?
Yeah, well, like I referenced, I mean, this is not easy. It's by far not easy, but it's also a matter of transition. And the goal is to be a sustainable organization. However, well, we know how it's defined, but let's not spend too much time on that now. But directionally speaking, it's clear that we will only have sustainable products, that we think about sustainability also in our business processes, the partners that we do business with. Well, the lineup kind of speaks for itself, I guess. Also internally, that leads to plenty of discussion. I mean, how do we come from here to there? I would also argue that, the fact of the matter is that in the institutional space, I cannot find one mandate or one client that doesn't want to talk about sustainability or does not have some kind of sustainable criteria that filters into, their ultimate investment portfolio. Simply doesn't exist anymore. So to close your eyes for that would be ludicrous. The speed with which I see that happening also on the private client side. And yes, I'm sure you'll be able to find an example, where that's not true. But in the midst of the hurricane that we're facing, I think anybody can deny the importance of being, aware, sustainability aware, so to speak, and that if you were to discount that, then for me personally, it would be okay then to come to the conclusion that we're not the right organization to service either an individual or an institution. Obviously, we want to do it gradually, right? I mean, we want to take the time to have that dialogue with our clients. Mm-hmm. So that speaks for itself, but the ultimate goal should be clear as well.
Mm-hmm. So a little like the car companies that are saying, all of our vehicles are going to be electric in a few years. If you want an internal combustion engine car, you're going to have to go find it from somebody else. So I think it's interesting we all know a big part of strategy is what you choose not to do. So I think that's a strong statement.
It's an interesting example, by the way, that you mentioned, because if somebody were to look at where the car manufacturing industry is today compared to 1, 2, 3 years ago, it's a massive change. And also in the buying behavior. So it's almost like it's snowballing, right? And then you better be in the midst of it instead of, being behind the curve, because it's going to be difficult to catch up.
Yeah, that's right. So you mentioned you think we're going into very turbulent times in terms of transition. Can you talk about that? You're, obviously a lot of discussion around COP26 about pushing for change. How do you have a crystal ball? How do you see this going forward? And what sort of turbulence do you are you preparing for?
Yeah, well, thankfully speaking, I do have a crystal ball, so that helps. But no, of course not. Nobody does. But in my mind, certain things kind of make sense and they add up, and it's almost like there's no argument that can kind of discount that. And I'll actually kind of build it up a little bit different, if you allow me, because I recently was at a well, it was in person, by the way, which is also great, after this long period of team and Zoom meetings. But we were listening to a speech by Martin Wolf. I think he's chief editor of the Financial Times, economics, well respected, has written a dozen of books. And he was kind of talking us through this whole energy transition, and he was saying, if you look at the wealth that we have, that was basically built off, oil and coal, i.e., carbon products that were able to literally fuel the industrial revolution, and brought us the wealth that we have, but with it also, a very dependency on exactly, these carbon resources, and that we all know now that we need to switch, and something that we've been very dependent on now cannot be part of the equation. Yes, in the transition, but increasingly cannot be part of the equation anymore going forward. That is, not only transitional. It's an entirely different equation, and it needs to happen in a relatively short period of time. Industrial revolution, 200 years, now we're talking about maybe a few decades. So we have no time to waste, right? And we need to act, and you see it accelerate. This was his analogy. And that means that, everything, all of the foundations that we've built are going to be retested. Business models are going to be retested. We're going to look at entirely different, for example, think about agriculture. How's that going to work, and how's that going to transfer in terms of world goods, and what is going to be produced where, if we're so dependent on energy and need to look for different sources, making it more local. And that was just an example. But that means that, it's not only the energy transition, it's basically all business models that need to change. If we don't have airlines, or airlines need to fly on different kind of energy sources, what's that going to look like? So the moral of the story also in his speech was, you better get ready for the hurricane. That's why I used that word, because he used that word. And I think he's right, and the negative thing about this is that there's no escape. And the positive thing about this is, we can play a role. Also as asset managers in close conjunction with the asset owners, to make a difference, by our investments in liquid strategies, but certainly also in illiquid strategies, where we can even more directly be a facilitator. And obviously, we need to balance risk rewards with, being part of that transition, but the transition is going to be all over the place. So, we better be also, I think, part of that transformation. And, that's what we're trying to think through. So some of the initiatives that we have on the table, are exactly doing that. We recently launched, this is April 1st of this year, recently, I guess, but a sustainable farmland fund. You're thinking, well, what is an organization like Van Lanschot Kempen doing with a farmland fund? But actually, I think it's a great proposition, because we know that farming needs to change, that it needs to become less dependent on carbon, that it needs to be more sustainable. So we have been identifying and building a portfolio of sustainable farmers, not the biggest in the world, but, kind of mid-size. And we've started to build a portfolio of that. Basically first started to build a team, of course, and then executing on this strategy. And, it's great to see, we had a launching client. It's a pension fund here in the Netherlands. It's public knowledge. It's PostNL that founded us with a couple $100 million. And now we've recently also added 2 insurance companies. We're making it available for our private clients. It's amazing, because it's a great story, because it's a story about how these farmers actually are transforming the business. It has an impact on biodiversity. I hear these stories sometimes, and they say, well, we don't harvest the olives at night because that's obviously not so good for the environment, right? It keeps the birds out of their sleeps and everything else. So it's really, really bad for biodiversity if we do that. But, mostly speaking, that's when the harvesting is taking place, because of the heat, because of the workers and everything else. It's a very, very small example, but I think it carries a lot of weight. If we can do a number of these things, we're trying to do the same thing now. We're looking at potentially also launching an infrastructure fund here in the Netherlands to basically also facilitate that transformation. That's where we can bring, our knowledge and our firepower together with the asset owners to the table, to make actual change. It's kind of the next thing to the impact question that you asked on the small caps, right? And this is the next frontier. Having said all of that, because, I think it sounds good, hopefully you think it sounds good as well, but it always needs to also make sense from a business case perspective. So this is not the business of social returns, if I may say that. It's not a disqualifier, by the way, but we need to balance the impact that we want to have, also obviously with making the returns that our asset owners need at the same time.
Well, those are, both the engagement with the small cap companies and this example of sustainable farmland or infrastructure. But what is great about both of those is that there are things that actually affect the planet. We think of those as catalytic investments, where an asset manager or an asset owner is scaling something, the scaling technology, or really, affecting a company, which is very different than what we see a lot of people just wanting to worry about their own portfolio and cleaning up their own portfolio, but maybe they do that by passing things to somebody else. So I think these are great examples of the investor actually having an impact, not just on the portfolio or of the investments, but actually recognizing that it's flowing through to biodiversity or the planet. So those are great examples. As you look forward, you've talked about the hurricane. We've some of us, depending on the country you're in, have experienced real hurricanes recently. We're expecting more of those. So, on the one hand, we've got these hurricanes, literal and figurative, coming. There's a lot of enthusiasm about sustainable investing. Obviously, some governments are really behind this. There's a long way to go. How do you see the next 5-10 years playing out when you do get that hurricane or that turbulence or that pushback or the gas price goes way up or whatever it is? How do we set expectations that it's not going to be a smooth road? There are going to be some ups and downs. There are going to be some setbacks. And just like, I'm sure there have been since 1737, as in investing, there have been I'm sure there have been a lot of stories and setbacks along the way. Because one worry that I have is people are so excited about this right now that they think we're going to be done, next year or something. How do we sort of, as you look forward, how do we build for the long term here and have that that strength and fortitude to get through whatever hurricane may be coming our way?
Yeah, well, I mean, I appreciate that the analogy to the hurricane may not always be as appropriate, but I think, and hopefully the listeners understand what I mean with it. There's no doubt it's going to be a bumpy road, and you only have to look even at the news in the last couple of weeks and, to see how gas prices have been and oil prices and everything else, spike and all of a sudden we're confronted. I mean, that has beautiful things as well. I mean, the demand for solar panels here in the Netherlands has gone through the roof. There's no insulation to be found inside for the next 3 months, right? So it's also a correcting mechanism, I hope, that will push us in the right direction. But bumpy it will be. And we can talk about that for a long time. I think, just going back to something that I said earlier, I would formulate my answer that as an organization, but also as a steward for the assets that we manage for our clients, be it institutional, be it on the private client side. We have to be part of that transformation and have to become more and more part of the transformation. There's no other way, I think. And that's going to lead to some successes, sometimes disappointments, from an investment perspective. Because if everything is even more in flux than what we're already used to, volatility-wise or otherwise, then you're not always going to make the best bets. That's going to be a given. So it's a bumpy ride also here. We should focus on the longer term and to the end goal, and to understand, which business models are going to be adapted, which are going to survive, which are going to thrive, and basically to set course on those, and accept all of the volatility and bumpiness that comes with that. I don't think we can afford anymore just to, for example, look at leaders in the space, or to only invest in companies that are already there. If that's what we continue to do, then there's not enough base in order to facilitate where the real work is in the transformation and everything that still needs to be done. Companies that are already there in any way, shape, or form, they don't need our help for all of the reasons that brought them to the place that they're in. And kudos to them, I guess. But the heavy lifting is going to be in the transformation. That's where we need to be also from an investor's perspective.
Well, I think your point of the combination of being a very long-standing and long-term organization and the being part of the solution, being part of the transformation, I think is very inspiring to others who are, thinking about how to navigate this. So I really appreciate your time today. I appreciate all the things that you were doing there at Kempen, and obviously we appreciate your longstanding involvement in FCLT Global. So thank you very much.
Thank you as well, Sarah.
Thank you.
Thanks for listening to today's episode of Going Long with FCLT Global. To learn more, visit our website at fcltglobal.org.